Welcome back to The Explainer. Today, we are diving into a real head-scratcher happening right now in the commercial real estate world. We're going to unpack the story of Piedmont Office Realty Trust, which trades under the ticker PDM. We're going to decode this wild 2026 run they're having, using nothing but the raw data, the hard numbers, and the strategies straight from their recent reports. If you love a good market puzzle, you are absolutely in the right place. Let's get into it.
Picture this. You've got an office real estate investment trust operating in a sector that, let's be honest, has been completely battered lately. They haven't paid a recent dividend, and they just posted a Q1 net loss. Yet somehow, they just hit a 52-week stock high. I mean, on paper, this sounds like a total contradiction, right? It totally defies standard market logic. But as we'll see today, the market is laser-focused on a very specific set of underlying metrics.
So here's our roadmap to figure this all out. We'll start with the Piedmont Paradox, look at their Sunbelt lifestyle offices, check out the Q1 2026 financials, dive into their leasing momentum, and finally, weigh the risks of their dividends and debt.
Starting off with Section 1, the Piedmont Paradox. Let's look at this stock that's basically defying market gravity.
Here is the core of the paradox. PDM recently spiked to a new 52-week high of $9.78 a share. And we're talking heavy volume here, over 64,000 shares moving in a single session. But here's the catch. They did this despite suspending their dividend over the last 12 months and running on negative net margins. Usually, if a traditional REIT cuts its dividend, income investors run for the hills and the stock tanks. Yet, PDM is climbing. And interestingly, major institutions actually own over 84% of the stock. To figure out why smart money is still sticking around, we really need to look at what Piedmont is building.
That brings us to Section 2, Sunbelt lifestyle offices. This is all about their flight to quality strategy.
Take a look at this visual standard. This brilliantly illustrates what they're up to. This isn't your grandfather's dreary, fluorescent-lit cubicle farm. It's a striking, modern glass high-rise. Piedmont calls these Piedmont Places, spaces that actually feel more like hospitality than corporate work. They aren't just renting out square footage anymore. They're selling a premium environment that helps companies recruit and keep the best talent.
It's like day and night when you look at the broader market right now. On the left, you have your basic commodity office assets. Older vintage, zero amenities, sitting in those single-use districts that are complete ghost towns after 5 p.m. A lot of those are becoming literally unleasable. On the right, you have Piedmont's focus, lifestyle office assets. These command premium rents. We're talking on-site retail, high-end fitness centers, outdoor spaces, all located in neighborhoods that are actually alive. Piedmont has gone all in on this premium tier. Get this, 72% of their entire portfolio has been developed or redeveloped just since 2010.
And it's not just what they are building, it's where. 100% of their 16 million square foot portfolio is strategically located down in the Sunbelt. Look at this breakdown. Austin is huge for them at 36%, Atlanta right behind at 31%, with Charlotte, Phoenix, Tampa, Dallas, and Houston making up the rest. They are intentionally piggybacking on the massive wave of corporations and people migrating to these specific cities for better growth and tax conditions.
Okay, so great buildings in great cities, but how is that actually translating to the bottom line? Let's hit Section 3, Q1 2026 Financial Snapshot, and peek under the hood.
Now we have to look at the hard facts here. When you look at the raw Q1 2026 numbers, it's pretty rough. Total revenue was actually solid at $143.3 million, even beating some expectations. But then, ouch, they posted a net loss of $12.9 million. That means an earnings per share of negative 10 cents, which missed estimates. And that net margin is sitting at a painful negative 15.28%. If you just looked at these metrics in a vacuum, you'd think the stock should be in free fall.
But right in the middle of those tough earnings, this one specific number stands out, 5.3 times. That is Piedmont's net debt to EBITDA ratio. It's basically a measure of their debt against their core operational earnings. According to their presentation, 5.3x is actually the lowest leverage in the entire office sector right now. So yes, they are taking a hit on net income, but their balance sheet discipline, it's incredibly tight compared to their competitors.
Still, low leverage alone doesn't create a 52-week high. For that, we need to check out the operational engine. Let's move to Section 4, Leasing Momentum and Demand, which is currently beating their historical averages.
430,000. That is an absolutely massive amount of square footage that Piedmont successfully leased in the first quarter of 2026 alone.
Their CEO, Brent Smith, pointed out that tours and proposals are flying higher than their historical averages. And you want to know the best part of this number? 2/3 of that 430,000 square feet was brand new tenants, not just people renewing their old leases. That flight to quality we talked about earlier is actually bringing fresh blood right to their doorstep. And because everybody wants a piece of these premium Sunbelt offices, Piedmont isn't just filling space, they're making them pay for it. They posted over 11% same-store net operating income cash growth. That means the real cash coming in from their existing properties is climbing fast. Plus, they saw cash leasing spreads of over 11%. Simply put, when a new tenant signs a lease, they are paying 11% more for the exact same space than the last guy did. This incredible demand is letting them push rents to record highs across the board.
And listen, this wasn't just a Q1 fluke. Looking at the data through June 1st of 2026, this momentum is holding strong into Q2. They've already locked down another 240,000 square feet this quarter, bringing the year-to-date total to about 670,000 square feet. And yep, nearly 60% of that is still coming from brand new tenants. Add a robust pipeline of another 700,000 square feet currently in negotiations, and you start to see the bigger picture. This forward-looking momentum is exactly what the market is getting so excited about, and it's exactly why they just raised their 2026 earnings outlook.
But to be totally objective, we can't ignore the risks. So let's wrap up with Section 5, dividends, debt, and risks, and weigh out the bear case. Let's talk about the elephant in the room, the debt. Piedmont is carrying a heavy $2.27 billion in total debt principal. In today's high-interest rate environment, that is a serious anchor. But here's the strategic advantage they laid out in their filings. They have exactly 0 debt maturities scheduled until 2028. Nothing. Their average maturity is over 48 months out. That means they don't have to refinance any of this at today's painful rates. They've essentially bought themselves a multi-year runway to let all that leasing momentum turn into cold, hard cash before the bill comes due.
Even with that runway, the risks for retail investors, especially those looking for income, are glaring. Wall Street is completely split on PDM. One buy, one hold, and one sell. As we mentioned, that dividend was suspended recently, giving them a dividend stability score of -0.79. That firmly lands in the unreliable category. And if we zoom out to a 10-year view, from 2016 to 2026, the stock is actually down 55%. It's lost about 7.7% in annual yield over that decade. So keep in mind, this recent 52-week high, it's really just a short-term spike inside a much longer historical downtrend.
So we're left staring at a really fascinating crossroads here. On one side, you have negative margins, a suspended dividend, and over $2 billion in debt in a tough sector. But on the other side, you've got a perfectly positioned Sunbelt portfolio, the lowest leverage in the game, and record-breaking leasing momentum from companies demanding high-quality space. So, what do you think? Can premium lifestyle offices really continue to defy the gravity of the broader commercial real estate market? Will this leasing boom eventually fix the balance sheet, or will the macro environment catch up to them? It's a massive question for the future of office REITs. Thank you so much for joining me on this deep dive, and I will see you on the next explainer.